All right, what's going on, everyone? Today we've got Jack on the podcast. Jack, thanks for being here. Appreciate you making time. And yeah, let's maybe just jump in with a little bit of backstory on kind of how you got started in real estate and where you're at.
Yeah, absolutely. Thanks, Kevin. So, for your viewers, my name is Jack Pettinger. I've been a multifamily underwriter for the past 5 or 6 years now, I guess. I have experience underwriting agency debt as well as at a state housing finance authority. So, really strong background in debt options, low income housing tax credits, and government bonds. Where am I in real estate? I feel like I'm still just getting started. We have 43 units, and I Airbnb out my house when I travel, so 44 if you count that.
That's awesome. What was like the first project that you personally got into? What was your first purchase, I guess?
Oh, let's see. I made my first purchase at the end of 2019. It feels like a lifetime ago. I bought a 4 unit and I converted it to a 5 unit. There was an open basement with a bar, and I was like, wow, this is so cool. It's basically studded out. What if I turned this into a fifth unit? And that's what I did. I went forward with the purchase of that 4 unit, and I said, I need to add value to this. I need to bump the rents. And this was how I saw a path forward to doing that. So I took that project, was super excited. I'm sure a lot of people on this podcast have been there. Super excited. I was like, I'm gonna be done with this project in a month. I was done with that project in a year and a half. So it was definitely a learning experience, but I'm glad I did it. Jumped into multifamily right away. At least, I call it multifamily, four to 5 units. Most people say multifamily is 5 plus. But I'm glad I did it that way because, while that fifth unit was being constructed and sitting vacant, I had other income to cover my debt, which is really nice. It it really worked out well. I always encourage people, if you're going to invest in real estate, it does not have to be a single family project you start with.
No, that's great advice. And yeah, I think the analysis paralysis gets to a lot of people, and sometimes it's just scary to take that bigger step into multiple units at once, especially first getting started.
It's super scary, but it's worth it. I mean, even if it's
Absolutely.
a duplex versus a single family, you have two tenants paying instead of one. Double the chance of covering your mortgage.
Absolutely. So you guys have, almost 50 units now. I guess what are some of your immediate, near future goals and maybe longer term goals specifically in real estate?
Oh, wow, real estate goals. I have a lot of those. I think near future, I'm trying to put together a tax credit development, so utilizing the LIHTC, low income housing tax credits, and fund an affordable ground up development. Been checking out some projects in the Michigan area, some in Illinois, and trying to look at some in Wisconsin. Other than that, on the market rate side, wanting to keep raising money and buying larger multifamily portfolios. We recently acquired a 34 unit, and what I realized in acquiring that is it's the same process to acquire a 7 unit as it is to acquire a 700 unit, just on a larger scale. And when we did one, I thought, why can't we do more? So we're out there putting out LOIs in this very rough market on 100 plus unit projects, and we think we can do it. So, very immediate goals, try and get a tax credit development off the ground, try and land a larger market rate development. I'm thinking at least 50 plus, ideally 100 plus. Long term, and people think I'm crazy when I say this, we're going 500 units in the next few years, and we're going 2,500 units right after that. I want to tell everyone listening to the podcast, don't limit yourself. If you shoot for the stars, even if you screw up, you're going to accomplish 5 times what you thought you originally could.
Absolutely. That's awesome. I think one thing that I like to think about a lot is, we have these goals, but what does that actually mean for actions that we're taking today and maybe habits that we've implemented? So I'd love to hear if there's any, specific things that you guys have implemented to actually achieve those things and, maybe just speak to that a little bit.
Yeah, absolutely. I think there's a lot we've implemented to achieve these goals. The first I'd say is get coaching. Get coaching. You cannot do it on your own. Well, you probably could, but it's going to take you a lot longer. It's very difficult to go from 5 or 10 units to 500 on your own. Get coaching and start networking. That's probably the biggest advice I can give because all of a sudden you'll find like-minded people, you'll pool resources, you'll pool talent, and you'll grow significantly faster.
Definitely, that makes a lot of sense. I think, one thing that I see a lot of people get caught up on is maybe, again, the analysis paralysis. So they do the education, they join a mentorship, they start consuming the content, and, 6 months, a year, 2 years goes by before they take action. But then on the extreme end, you have people that just take massive action, that don't necessarily build the best foundation, might learn some lessons the hard way. So,
Are you
that's
talking about both of us?
there's definitely a happy medium there, and I'm curious specifically in your underwriting background if there's any common trends with the people that may be on the scaling end of that, if you see any, reserves or certain things that are implemented to maybe not go underwater on projects, not overextend yourself, or maybe speak to things that you've seen, like a common trend when projects do fail, or what, maybe the common trend there is, if there is one. I don't know.
Yeah, absolutely. I think for projects that don't fail, it all comes down to good underwriting and good reserves. As you know, the markets are all over the place with interest rates. And recently, agency has been handing out interest-only periods like candy. There's like, and you get interest only, and you get interest only. The problem with that is that when you're in an interest-only period, you're not paying down any debt, and what during that period, whether it's 5 years or 10 years, your property value is fluctuating. You buy a property at 10 million, you get interest only, you're cash flowing for 5 years. Great, but what are you going to do year five when you need to refinance? Rates are super high, cap rates went up, and now your property's worth less. It's worth 8 million. What's the objective there? I think a lot of this is happening right now in the market. In fact, a few weeks ago, we saw 300, I think it was 300 units that Arbor had financed, and they got the keys handed back to them. We call that jingle mail. Send the keys back because my property lost value. I'd be very nervous for anyone going in with interest only and not a significant plan to add value to that property. I think it's really risky. Flip side,
I
things
mean,
that things that work. You know, it's great to say I have the down payment, but you need something beyond that. You need a down payment, and then you need reserves to operate the property. And I think people forget about that. And they're like, woohoo, down payment, I made it. Well, hold on. You also have to have the cash to get through the operating period or the renovation period. And things happen. Things happen. I've had huge expenses come up on a 2 unit building, and I wasn't prepared for it. You need to have those reserves if you want to be a good underwriter and you want to be a good operator.
great advice. Yeah, we've seen, 24,000 for a sewer line on a single family. I mean, that's what, 8 years of cash flow. You
It's
can
eight
only
years of
set so
cash
much aside.
flow.
So
But that
when
was a
you
great
say
day.
yeah, absolutely. When you say, reserves, I guess, as an underwriter, what makes you comfortable? Are you looking for, hey, their projected expenses are this, 6 months in reserves, 3 months? I know everyone kind of has a different, but what I guess is like maybe the conservative side of that really, as an underwriter, makes like you comfortable.
Right, I feel very comfortable with 6 months of operating expenses. That's kind of my goal. I want to get there. That's what I want to hold. If we're just breaking even, paying off our debt, I can operate that property for 6 more months while we figure it out. Obviously, that's a worst case scenario. We never want to
Right.
get there. But the truth is, you might. You might. You don't know what's going to happen with the market. You don't know what's going to happen at the building. You don't know if there's going to be a huge issue or a lawsuit or, something goes wrong. So I personally feel very
Absolutely.
comfortable about 6 months. The low end I would go is 3 months of operating reserves, and that's OpEx, of course, of operating expenses. Makes me a little uncomfortable. I understand starting there and maybe building the reserve, but I really like to operate with that full 6 months.
Absolutely. Something else maybe that you can speak to, especially with some of these more affordable projects where I assume your repairs and maintenance probably runs on the higher side. Those are some of the things that you can't necessarily look at owner financials to determine what you are going to be incurring, especially with a lot of these mom and pop owners where they're probably doing some of the repairs themselves, or they got the brother who does it for $5 an hour. We've obviously seen a lot of that. Is there any kind of guidance or rules of thumb that you could share with, where you kind of see an average lie, whether it's a price per unit per year? And I understand different asset classes, but any guidance there?
Yeah, that's a really hard question. In general, I tend to underwrite between 450 and 600 per unit, and that's assuming the units are in decent shape. And if they're not, it's not uncommon to see 700-800 bucks a unit. I know that sounds crazy, but if we're talking about low class C properties or even class D, God forbid, I don't touch them. Um, I- it's very possible. And what's happening there is the building needs to be upgraded, the plumbing needs to be upgraded, whatever it is, and it's not being taken care of. It's deferred maintenance. You get to that situation, you have $700 in repairs per these low income units or these units that are just not doing well. You're not really looking at a $700 repair year over year. What you're looking at is a ton of deferred maintenance. Can you put 5 grand into the apartment so that comes back down to 450, 5, 600? If not, can you operate with it at 700? And are you prepared in the future to still put in a big capital investment when something goes majorly wrong? Maybe right now it's a
Right.
repair, and later this has to be completely redone.
Absolutely. No, you're bringing up a lot of things that we didn't necessarily understand on, really that first 20 unit we purchased was exactly what you just kind of described. Looking at his repairs and maintenance, it's like, okay, but he's kind of running this thing into the ground, and we're kind of shooting a shot in the dark on where that's going to fall, knowing, hey, we are going to completely renovate the majority of these units. So yeah, that's definitely a hard piece when you're, I think, first starting and you don't have your portfolio data to look at and see how things operate. But any other specific, maybe underwriting tips or specific things to look for in that regard that you see come up, or big mistakes people make when they are underwriting?
Hmm. I see a lot of big mistakes people make when they're underwriting. Let me think of some big ones. Trusting the seller's numbers and the broker's numbers actually for that point. Just what you said. Oh, the seller's R&M is 200 bucks a unit. Okay, it's probably not. It's probably not. They're either not telling you the whole story, they're doing some of the repairs and maintenance themselves. Something's going on there. I see all the time people are like, I'm buying a 7 cap property. If you're buying a 7 cap pro forma, you're not buying a 7 cap property. You're probably buying a 5.5 cap property, and the broker's saying, oh, it will be a 7 cap once you raise the rents and once you lower these expenses. No, it's not. This drives me nuts when people say that. You do not buy on pro forma cap. You buy on an actual cap, and that's what you should be communicating. Mr. Broker, this is not a 7 cap. This is a 5.5 cap, and this market's actually a 6 cap. You're off on your pricing. So,
Absolutely.
yeah, there's so much, and the other two I really want to focus on because I see people do this wrong all the time. Taxes. Your taxes are going to go up, people. I promise. I promise. I got the bad end of the bullet on this one time. I was like, oh, look, the taxes are only 10 grand. My taxes went up like 50% the next year because the city had seen that I purchased the building much higher than it was assessed for. Your taxes are going up. Look at insurance yourself. Mr. Seller is getting 250 a unit in insurance. You better call around and start getting quotes because I'm telling you, inflation is going up and we're paying more and more day in and day out. So Those are my big ones. Don't trust the seller's numbers. Don't trust the broker's numbers. Verify all of that. And then taxes and insurance, you need to do your own analysis.
Absolutely. I love the insurance one and the taxes. Yeah, I mean insurance. It felt like in the past 2 years has even gone up to 450 a unit on some of our properties.
Yeah.
Another thing to your first point about your actual going in cap rate. What we've been actually utilizing a lot, especially with interest rates moving, is just showing, hey, I'm not going to haggle you on whatever your number is, but who's the lender you're currently using? And now I have a referral from their lender, currently has a loan with it. I'll take their underwriting, adjust it, say, hey, this is where I think we're actually going to be at, and then really use the debt service coverage to show that, hey, this is hitting a point 0.8. Like we can't get this financing. That's putting 30% down,
With
and
your
it's
bank.
right with your bank and your terms and your expenses, and on your actuals, it's a 0.95, and so obviously that's a big gap to bridge, but sometimes that helps reset expectations. So as much as you can stress test, hey, this is going to be worth $5 million and I'm going to refinance and burr everything out. I think my biggest underwriting kind of like tool that helps me is just stress testing the DSCR. Like, okay,
Oh,
we
yeah.
can refinance everything out. Up to what interest rate does it hit? 125,
100%.
and that's really helped me because some of these values that we've even gotten on our buildings is like, I don't think anyone's paying that. Does it hit debt service though? And now, I know if it does appraise, at least I know we can refinance and cover. So that's one, I guess, tool that I've kind of implemented. That's a pretty easy thing to check.
Absolutely. Stress test away. And, I call that on paper money. The appraiser says your property's worth 5 million. You're like, I could never get 5 million on the open market. It doesn't matter. As long as you can refi and still hit a 125 DCR, the bank's gonna do it. Most
Right.
banks, my opinion wrongly, really trust those appraisals. Well, guess what? An appraisal can say whatever it wants, because they generally use an income approach. How much money is the building making? An income approach does not translate to a sales approach. This is what someone will actually pay for the building if you need to sell it.
Right. Absolutely. So to move maybe more towards 2019, you're just getting started buying that first 4 unit, turning it to a 5. Anything you'd do differently when you were starting, or if there's not, maybe advice you'd give to someone that is kind of starting out and maybe a starting point, I guess.
Is there anything I'd do differently? I think anyone in real estate would look back and be like, oh shit, yeah. Yeah, there is. There is a lot I would do different. That said, I don't regret it because I had so many lessons I learned, and I would not be the underwriter, the manager, the person I am today without all of those really hard, stressful lessons. Now, what would I tell people just starting out or maybe who haven't started? My first point is going to be do it. Just do it, okay? I, I can't stress it enough. I know you're worried. I know you're concerned. I know you think everyone else has the skills, the time, the money. I promise that's not true. Listen, I was a multifamily underwriter and I was like, shit, I can't do this. I, I didn't feel like I had any advantage. I walked in, my first 4 unit, I thought I was gonna be done in a month. That's crazy. That's crazy. I was building out another unit. Of course that wasn't going to happen. Do it. Start. Learn. It's going to pay off. Real estate is not about when you get in the game, it's about how long you're in the game. Or as other people like to say, it's not about timing the market, it's about time in the market. Hold on, real estate pays off, and long term, real estate has produced more millionaires than any other asset class. That is a fact. You can double check me. You can do it. The only piece of advice I would give that I super messed up on is schedule time to work on real estate. I was like, and Saturday at 11 a.m. and Sunday at 7 p.m. It was crazy. I was all over the place. It was just not structured at all. Now listen, if you say from Tuesday from 6 p.m. to 9 p.m., I'm working on real estate, Well, you're probably getting a lot more done. You're not just browsing LoopNet. Maybe you're actually running expenses on a few properties. You're calling some brokers. You get a significant chunk of time, and you're doing that consistently every single week, week in, week out. All of a sudden, you're going to see your growth take off.
Absolutely. And I think you would probably agree with this, and you kind of hit on it with the time in the market over timing. It's very forgiving too, especially you don't have to start with 100 units, but you also don't have to start with a single family. And we learned on our first 20 unit apartment complex that our budget was 50% of what it actually should have been. Our pro forma rents were way low. Like all of these things that we did wrong, and we were still able to refinance our investors out, maintain equity, cash flow. And I think that's just a really cool piece of real estate. And that wasn't just market timing carrying us up. It was just a true value add, and the kinks kind of work themselves out. And I think that really is kind of a beauty of real estate.
Yeah, absolutely. And I would tell everyone, go look at the value of real estate over time. It does not fall long term ever. It hasn't, not in the US markets. And I love when people are like, real estate can't go up forever. Actually, you're wrong. Can I tell you why? Because as long as the government continues to print money, real estate will continue to go up in value indefinitely. It, I mean, it's common sense, people. There's more money, more people can afford to buy the real estate, the prices go up. It's going to keep happening. Real estate is a very stable asset class, and frankly, our government's out of control, not putting any political opinions in there. Real estate can keep going up, and it will keep going up. And I don't mean to say that in a, oh, it's going to go up 20% year over year. I mean to say that in a steady, consistent growth over time, it will go on an upward.
Absolutely. Now, this next question obviously ties into the title of our podcast, Midwest Multifamily. Now, you obviously live in the Midwest, which is going to, I'm sure, contribute to the reason you're investing there. But outside of that, are there any things you see on the underwriting side or just overall attractiveness of kind of the Midwest markets?
Kevin, I don't know if I want to answer that because I don't want people coming to the Midwest and stealing my properties. No, I will answer. Obviously, there's a lot of area here in the Midwest to compete, and hopefully you and I are going to be dominating the Midwest by the time everyone else realizes. I'm so glad you asked this question. I hear something all the time, and I'm going to say something very controversial here. Florida, Texas, Georgia, these are the markets you want to be in. Nashville, you want to be in South Carolina. Rent growth 20% year over year. Those are not the markets I want to be in. And let me tell you why. Because when you start looking at Florida and Texas, those tenants are paying 40 to 50% of their income as rent. You cannot keep raising their rent. It's unsustainable. I think we're going to see rents drop in those areas as hard times start hitting and we head into a recession. Now let's bounce back to the Midwest. That is not the case in the Midwest. It's very affordable to live here. Depending where you are, most people have steady, stable incomes. You're right, it's not 100, 150, but if you're looking at someone who makes 60 grand and their rent is $700, that's still very affordable.
Super affordable.
Very affordable. And then just in general, I like Midwestern people. I think we're nice. I think we all have the same goals. And when we're here during the winter, we complain about it. We're like, this sucks. We hate it. And then when everyone else trashes our states, we're like, get out. We love the Midwest. You're all great people. We band together.
That's awesome. No, I appreciate you sharing that. And I'm not sure you kind of hit on this, and this ties back into the underwriting aspect too. But something I like to see is the population kind of income chart, and then how many of the people in the population actually would qualify for our one beds, or
Yeah.
what does that look like? And to kind of touch on some of those hotter markets where you're right, they're kind of at that max of where rents can go and people can survive on some of the, especially Class C stuff, I would say. And yeah, exactly what you just said is some of our properties where we've got people making 50, 60 grand a year, renting our one beds for 750. And what is that, 20, 25% of their gross monthly income, which, is far less than some of these other places. So, um, yeah, definitely agree with you there.
Yeah, and one more thing on the Midwest, because I really believe in the Midwest. My company's called Invest Midwest. We're not going to Florida. I'm not interested. It's that job growth in the Midwest is going to continue because we're affordable labor and we have affordable land. And for the most part, there's a lot of business-friendly states up here in the Midwest. So you take all of that and you see companies like Intel go, oh, Columbus looks awesome. You see companies like Foxconn go, oh, just south of Milwaukee looks awesome. You see this influx of job growth, Amazon, Microsoft, because they don't want $150,000 labor for general labor. They don't. They want someone they can pay 40 to 60 grand, get the cheap land. They're operating very profitably. And then the market is super sustainable and takes off. Microsoft isn't going anywhere. Amazon isn't going anywhere. They have hubs all over the place in the Midwest that's promoting job growth and will allow room for rent growth eventually in the future. Long-winded
Absolutely.
answer, but I'm very passionate about that one.
No, you brought up the Intel plant, which is not too far from most of our stuff, and actually got pretty cool news yesterday that Google just bought land in Lancaster, which is where Ethan, my partner, lives, which is where actually our portfolio is. So that was
Hmm.
awesome news. So, yeah, you hit that nail on the head there. But well, Jack, I really appreciate you hopping on here. Obviously, your big goals in the Midwest. Where can people connect with you?
Yeah, absolutely. I'll throw my email out there and then my website for you so you can drop them in the
Definitely.
chat links. But email is jpettinger at Invest Midwest CRE. Again, that's our company, Invest Midwest. And then you can also reach out at investmidwestcre.com. And Kevin, I promise I'm going to work on this because I've been trying to brand better. We are just launching our social media platforms at the Multifamily Millennial, so make sure to follow us on those.
Awesome. Well, thank you again for coming on here. Ton of information and knowledge on the underwriting side, and I certainly learned a couple things. So appreciate your time here this morning.
Yeah, thank you for having me.